Today we're going to talk about multifamily investments and specifically small multifamily. Right now in the Toronto market, and Ontario market, and even Greater Canada, we are looking at trying to solve a housing crisis, and a lot of municipalities have decided to give as-of-right zoning for duplexes, triplexes, quads, and fiveplexes. For the average investor, we're going to talk about how do you buy one of these things. We can also talk later about how to develop one of these things, how to finance them. But for today, we're just going to talk about the basics of buying a multiplex. What I want to say is we have different income classes in what I would call institutional real estate. These are small multis are not quite institutional, so they're great for small investors to buy. You won't have competition from pension funds, although there's a lot of competition from your neighbors or other small investors. But at least it's in a snack bracket that people can play in and invest in. A lot of people have been buying condo units in buildings and renting them out. This is not what I'm talking about. What we're talking about is a purpose-built rental that could be either a duplex, triplex, or a quad, or 5 units, or 6 units, or 7 units. Basically, you're buying income. And income in real estate, whether it be residential, retail, office, industrial, trades at what's called a capitalization rate, or we say cap rate. And a cap rate is literally just the income divided by the price you pay. As an example, if you have income of $100,000 and you pay $1 million for this income, you have a 10% cap rate. Now, I'm going to say right now, if you can find anything in those assets that gives you a 10% cap rate, you should likely put an offer in on it, because that would be a great price. It's really not the price per se of the asset, it's actually the cap rate you're buying. If someone says, I'm going to sell this property for $3.2 million, that's great. We don't know whether that's a good price or bad price. You have to compare that price to the income that you're buying, because really all you're buying is cash flow. That is lesson one. But let's talk about why cap rates vary. If you're looking at a multifamily property, they traditionally trade lower on the cap rate scale. I've seen them as low as 2% and as high as 6%. Obviously, if you're doing cash on cash returns, meaning like I say I paid $1 million of cash for my 10% return, that's probably pretty good. You'd probably feel pretty happy with that. But the minute that drops down to a 4 or a 3, you're going to say, geez, I think GICs are going to be a better investment for my cash. So that's an overly simplistic way of looking at it, but what you have is you end up with leverage. You have to end up financing these projects. And that's where Dorr Capital comes in. That's where what I do as a business, we finance this type of stuff. You would need to contact a broker of some kind or a lender that does this to help you with the financing. And then what you look at is your cash on cash rate of return. That is the basics of what you're doing. You're buying a cap rate. You need to look at what the financing would be, what the cost of that financing would be. Then you look at the cash on cash returns. Once you've paid your debt, you're going to have a debt coverage ratio that looks like something like 110 to 120 or 130 or whatever it might be. And then that cash flow, that 0.3 or that 0.1 or the 0.2 divided is actually your return, your cash for the down payment you paid, and you look at the return there. This is actually the basics of investing in multifamily residential real estate. And depending on the location you're at and depending on how much upside, meaning like if your rents are low and there's a potential to increase those rents, you may pay more or less for the cap rate. How you would look at a different area is a whole other topic, but this is step one.